Video script 9.3. Loss aversion. Why losing hurts more. John sits in his dimly lit office, the blue glow of his terminal reflecting off his face. On the screen, a red line is trending downward. A few months ago, John invested $50,000 into a new line of experimental haptic feedback keyboards. He believed in the technology, but the market has shifted. The project is now valued at only $30,000. Mathematically, John knows that the $20,000 is gone. It is a sunk cost. If he were the perfectly rational economic stickman we discussed earlier, he would evaluate the project based on its future potential alone. If the remaining $30,000 would earn more if invested elsewhere, he should shut down the project immediately. But John can't bring himself to click the liquidate button. Every time he looks at the screen, he feels a sharp, physical pang of discomfort. It's not just about the money. It's about the realization of the failure. He finds himself hoping for a miracle, a sudden market reversal that will bring him back to break even. John is currently being paralyzed by one of the most powerful forces in behavioral finance, loss aversion. As Brealey, Myers, and Marcus explain, loss aversion is a core component of prospect theory, developed by psychologists Daniel Kahneman and Amos Tversky. Their research demonstrated a fundamental flaw in traditional financial models. Humans do not value gains and losses equally. In the rational engine model, the joy of gaining $1,000 should exactly offset the pain of losing $1,000. But in reality, for John and most other humans, the pain of a loss is psychologically about twice as powerful as the joy of an equivalent gain. This asymmetry creates a distorted value function. On a graph, the curve for losses is much steeper than the curve for gains. This means that losing $1,000 feels twice as bad as winning $1,000 feels good. Because John is loss-averse, his primary motivation has shifted from making money to avoiding the pain of realizing a loss. This psychological quirk leads John directly into a second trap, the disposition effect. This is the tendency for investors to sell their winners too early and hold onto their losers for far too long. John looks at another part of his portfolio. He bought shares in a neon glass factory for $10,000, and they are now worth $12,000. Because he wants to lock in the feeling of a win and avoid the risk of that gain disappearing, he sells the shares immediately. He takes his $2,000 profit and feels a brief surge of pride. Meanwhile, he continues to hold the failing haptic keyboard project, watching it drop from $30,000 to $25,000, then $20,000. By holding the loser, he is gambling on a recovery just to avoid the finality of a loss. Statistically, this is the exact opposite of what a professional should do. Professionals are taught to cut their losses and let their winners run. But John's biology is telling him to cut his winners and let his losses run. Mankiw's insights into behavioral economics suggest that this behavior is linked to how we frame our reference points. For John, the reference point is the $50,000 he originally spent. As long as he doesn't sell, he can tell himself that the loss isn't real, it's just a paper loss. The moment he sells, the loss becomes part of his history, and his ego takes a direct hit. This leads to risk-seeking behavior in the face of losses. When John is in the gain zone, he is risk-averse. He takes the $2,000 profit and runs. But when he is in the loss zone, he becomes a reckless gambler, throwing more time and energy into a failing project just to avoid admitting defeat. This is how small business setbacks turn into total bankruptcies. The impact of loss aversion extends beyond just trading stocks. It affects John's entire corporate strategy. Imagine John is considering two new projects. Project A has a 50% chance of making $100,000 and a 50% chance of losing nothing. Project B has a 100% chance of making $45,000. Even though the expected value of Project A is higher, $50,000, John will almost certainly choose Project B. He is willing to sacrifice $5,000 of expected wealth just to eliminate the possibility of feeling a loss. This safety-first mentality can protect him in the short term, But in the long run, it means he is consistently underinvesting in the high-growth opportunities that define a market leader. He is playing not to lose rather than playing to win. To break free from this trap, John must learn to adopt the blank slate mindset. He must ask himself, if I didn't already own this project, would I buy it today for $30,000? If the answer is no, he must sell it immediately, regardless of what he paid for in the past. He must learn to view his portfolio as a collection of current values, not a history of past prices. Professionals use stop-loss orders, automated instructions to sell if a price drops below a certain point, precisely to take the humanity out of the decision. They know that when the red line starts moving, their brain will try to lie to them. John looks back at the red line on his terminal. He realizes that the $20,000 he lost is the tuition fee for this lesson. By refusing to sell, he isn't protecting his money. He is only protecting his ego, and the ego is a very expensive thing to maintain in neofinance. He takes a deep breath and executes the sell order for the haptic project. The pain is sharp, but it is brief. Suddenly, he feels a sense of relief. By accepting the loss, he has reclaimed his most valuable asset, his mental clarity. He now has $30,000 in liquid capital that he can move into a project with a real future. He has learned that in the business engine, a loss is just data, and the faster you process that data, the faster you can return to building wealth. John is no longer a prisoner of his past mistakes. He is a strategist who understands that losing is a part of the game, but letting a loss define you is a choice.